Hey guys, welcome back to the Results Junkies podcast. Paul is sitting at his desk, I am sure feverishly working on beacons, right?
I'm playing whack-a-mole with a bunch of stuff this week, but it's tax time, right? So it's a lot of paperwork.
Only if you don't file an extension. And then tax time becomes much more nebulous.
Yeah, I was going to say, I think I'm pretty close to actually having to file that extension. We'll see.
It's amazing how much your life changes when you realize you're just never going to make April 15th and you just tell them to file the extension early.
Well, you know, the thing is, nobody ever tells you, okay, so this might be a little bit of a rant, but nobody ever tells you with all those syndicates. You remember years ago, we were doing a lot of those syndicates on AngelList, and nobody tells you how many K1s, effectively you need one K1 for each of those, right?
Right.
But you can't really generate those yourself if you used a platform like AngelList to do it. So,
and AngelList doesn't automatically generate the K1s?
Last year, for whatever reason, I just remember the K1s just arriving, and when it was time to put it all together, we just sort of dug it out of email. But this year, it seems like we might have missed a notification of the administrator changing or something like that. So I don't actually know what happened behind the scenes, but I'm trying to herd cats right now.
Well, I mean, that's such a great segue. God, you're so good at this podcasting thing. All right, so on the subject of herding cats. All right, real quick, though, let's do a little housekeeping, and then we'll herd cats. So first off, if you're just tuning in, show@resultsjunkies.com is where you can send us email with questions, comments, concerns. And if you want to find us on social media until they get rid of TikTok, he is at Paul Singh on all those social media channels, and I am at Pizza in Motion. All right, so on the subject of herding cats, when last you and I recorded, you'd mentioned a couple of action items, and we'll start in reverse order.
Oh man, here we go.
Because you mentioned that you owed Alex an email, who was nice enough to supply some pictures of you underneath the trailer, and it appears that Alex had a little bit of free time on his hands, and I want to commend him on his efforts, but he did send over some custom art for us. So here's the first one on the screen. You should be able to see it on the screen now. Yes. If you're listening, this is the first for us on the Results Junkies podcast. Good reason to tune into the video feed so you can see the trash talking that Alex is doing. But not to be outdone, I mean, he sent me like 10 of these. I had a really tough time narrowing it down to my top 3. So this was another great one too. Write down to-do items. That's not a Paul thing. Have Ed remind me to do things when recording the Results Junkies podcast. So I'll be your Todoist subscription this week, Mr. Singh. And then finally, just because of the age I come from, I really appreciated this last one from Paul, just based on how old I am and what I grew up with. And it's remember when Paul said he would respond to those emails? Pepperidge Farm remembers.
Oh, it's so good. So good. Well, I will tell you that I did email Alex, and I might have some surprises for you next week. So we'll see. I think Alex might be playing both sides on this.
I'm okay with that. Content is king, man. You know the rules. Content is king.
Is it bad actually that so my brother-in-law is pretty good with memes too, and we've got this family text chain, and I don't know how he does it, but he's always just throwing memes in there. And I don't know if this is showing my age, but every time he does it, or every time Alex has sent you these things, all I can think of is like, how do these people do this so quickly?
I don't. Yeah, I would not be able to. But God bless him. Love it. I mean, I'm sure I could stumble through it, but it would take me easily 6 or 7 hours longer than any other human to do these things. Same. So yeah, we all have our skills in life. This is not one of mine, but apparently follow up is. So on behalf of Matt Paulson, I just want to check in on that follow up too.
Oh yes, well I did copy you on an email to him a couple days ago.
Yep.
And so it is not available publicly, but I have been testing the emails every day. So maybe you'll have it too. Here's the thing. If I put you on that email list right now, you're just going to get the same incorrect answers every morning at 8 a.m., which is going to further...
and there's so many jokes to take from that comment. I'm going to leave them all alone.
Lord. Okay. All right. The short answer is no update there.
All right, so we're gonna talk. We're gonna talk a little bit about Uber and Instacart in the ad environment. Something new that we haven't talked about with those business models. But we're gonna start with a podcast episode that I listened to, and it was the founder of Layoffs.fyi, a site that we've referenced frequently. And he had a few stats that I wanted to throw out here and then get your feedback on because they were pretty. I don't know that they were surprising per se, but they are jarring when you think about it from the bigger picture. So, first off, he noted that there's a quote out there, and I couldn't find the exact quote, so I took his version of it. PitchBook is out there saying that 3,200, that's 3,200 venture-backed startups shut down in 2023. It also says there was a 70% increase in layoffs in tech from 2022 to 2023. And finally, he said that there were over 200,000 individual tech startup layoffs in 2023, which was 3 times the number in 2020. So zoom out for a second there and have you tell me, your first thoughts when you hear those numbers.
It's a reminder of two things, I think. The first is that because there haven't been any real exits for investors, the bar continues to get higher for the companies that want to raise more money. And on the flip side, I think that just given how many companies got funded over the last couple of years that are now coming back for more money, the competition gets higher. So anyway, the TLDR, the bar has gotten a lot higher for that second or third round, whatever we call it these days.
Yeah, the names have all been bastardized for sure.
Right. Yeah. I mean, what is pre-seed, post-seed, series? I don't even know what the names are. It's just that if you're coming back to the, if you're coming back to the watering hole, the bar is probably, I don't even know, but I feel like the best broad hand wavy comment here is that whatever you think the bar is to raise money right now, it's probably 10x higher than that. And that's probably true on the exit side as well. I mean, I just don't see a lot of good M&A happening right now. I mean, obviously people will point at like the few, big M&A that's happening every once in a while, but that's not the norm right now. The reality is that growth is king right now. If you've raised any money or if you think you're going to exit, growth is the only thing that matters. And even then, that might not be enough to close the deal. So,
yeah.
But man, those numbers are huge.
Yeah, and he said something that I thought was a very astute observation, and I wanted to, get your thoughts about it because it's something that we've talked about, maybe not on the pin, but all around it. His note was, and I took some brief notes here. He said that in reference to the stat about the 70% increase in layoffs from 2022 to 2023. He said that when he looked through the names, that he saw some synergy there, and that wasn't his word, but my word, some synergy there between the companies that really bulked up on hiring during the pandemic. So companies that grew, exponentially, Slack, Zoom, some of the social media stuff that we really binged while we were, trapped at home. And that now they've begun thinning those ranks back. And it sort of dovetails into the discussion you and I have had about seat licenses and seat license recapture and numbers going down and all that stuff.
Here's maybe I don't mean this as a tangent, but I am curious what your thoughts are. These numbers are pretty big. But I haven't heard anybody on, the nightly news talk about it yet. Is it that these numbers are big to you and me in this industry, but small to, I guess, normal people, or what is it?
I don't think most people watch tech jobs for sure, because I think most people like that when you talk about the nightly news, those folks for the most part are going to be other industries, just because tech jobs are not the lion's share of the jobs out there. Well, plenty of tech enabled jobs, but teachers, firemen, policemen, restaurant workers, all those sorts of things. There's sort of a mixed bag. And I won't remember the numbers exactly, but I remember there was a Wall Street Journal article a couple days ago, might have been over the weekend, along the lines of that there was robust job growth in February, but that the unemployment rate still rose. So I think that sort of paints this lumpy picture for folks out there. There is job growth. People are able to get jobs, but there are also more people re-entering the workforce, I assume, to drive the unemployment rate up. And so those sorts of people, like people re-entering the workforce, aren't founders, and probably aren't taking their next job at a startup. They're probably people who worked for UPS during Christmas or something like that. Stuff like that. So, and now they're seeing jobs pop open, so they're coming back out and trying to grab a job again. I mean, as much as you and I talk about it, I don't think this tech and startup ecosystem is a big part of people's mind share for stuff like this.
Yeah, I mean, you're probably right. It just because the next question is, where are all these people going? Because it's like 3 or 4 years ago, it's like anybody that actually got let go went off and started something, and
Right. Yeah.
probably raised some money. And but what are they doing now? I mean, getting employed somewhere else? Maybe that's a rhetorical question, unless you have some thoughts there. But the numbers are just massive. I mean, we're not even done with the first quarter of the year yet, and we're into the six figures of layoffs.
Yeah, and the only thing I remember from the article that I read was that healthcare jobs were one of the areas where there was a definite spike in employment. I don't remember seeing any sector reports on the restaurant industry, but I would expect that sector would also be down generally, just because I think technology forces a deflationary environment in restaurants, kiosks, digital ordering, stuff like that. So, I think that from a tech standpoint, I do know people. I mean, like, look, we talked to Julian, and Julian's a guy who was a part of the mainstream workforce for quite some time and is now doing his own startup, PointsPath. But I don't hear a lot of those sorts of stories. I know some of them exist, but they don't exist in the, tens of thousands, if you will. Maybe they exist in the thousands. It's definitely an odd environment, and I think the uncertainty on the bigger checks causes so much pressure.
The thing I'll just kind of come back to is that if you're trying to raise money, I think the bar is probably 10x higher than whatever you think it is. And even if, and on the flip side, if you think you're going to exit, the bar is probably 10x higher than you think it is. And it's kind of where we are right now. And I think strategies need to adjust. I think tactics need to adjust. And for whatever reason, they don't seem like they have. I imagine your inbox is like mine in the sense that the people you funded are usually writing to you at least once a month. Well, I should say hopefully once a month, but at least once a quarter they're giving you updates.
More like once a quarter. Yeah, I wish it was once a month.
How do I say this? Like if I were to like anecdotally average out the emails I'm getting right now from the existing portfolio, we've gotten past a lot of the doom and gloom in terms of, oh gosh, we got to like right side, like everybody that's smart about this right-sided their burn rates like a year or two ago. And on the flip side, fundraising is not on anybody's roadmap, at least not, companies that have already raised a year or two ago, at least the ones that I know. Fundraising is just not on, it's not something they're mentioning in their quarterly updates. It's just not on the radar. Everybody that's in the middle of it right now is just thinking, okay, I've right-sided my expenses and I just need to focus on growth. And anyway, is that kind of what you're seeing in yours as well, or what are you seeing?
Yeah, I also think I'm seeing a little bit of a slowdown in the number of updates, and my guess is that that's because some of those companies have hunkered down a bit. I did send a couple emails out to people to ask for updates, and I think some of it is just that they probably had some trouble trying to raise if they were, or they're trying to figure out how to, I wouldn't say right size the company, but put themselves in a position where they could raise, which likely means boosting revenues, trimming some staff, things like that. Tough decisions, and that's kept them from sending me more timely updates. So I would imagine that some of the replies I get will be not sunshine and roses.
I'd be interested if anybody listening to this is actually part of that group of people that are getting laid off. I mean, even if you can only talk anonymously, I think it'd be interesting to kind of hear anything people are willing to share about, what they're doing now or how they're sort of navigating this. I mean, we'll keep it anonymous if you're up for it, but I'm just wondering where all these people are going. I mean,
Yeah.
200,000 people is not small. I mean, I get what you're saying. It's not mainstream enough and all that, but 200,000 people, and their mortgages and their rents and their daycare costs. I mean, that's not inconsequential.
Yeah.
And from the look of it, it's not going to slow down. I mean, this number, if you just plot this out over the last 90 days and you start to extrapolate it, this number does not, level off for any time in the near term.
No, I wouldn't think so. Yeah. All right, so let's talk about the ad picture here at Uber and Instacart, because this took me a little bit by surprise, and I've tried to do a little bit more Lyft than Uber as of late for a few reasons, but I still end up doing a bunch of my stuff on Uber, and so I don't do a bunch of Uber Eats, but the article that we'll link to in the show notes had two interesting tidbits, and I'll read from what I sent you just because I think they're really interesting nuggets. First off, that Uber expects $1 billion in ad revenue in 2024, which has to be fairly high margin business for them. Clearly higher margin than anything else that they do, but maybe not exponentially since they're mostly a services business. And then Instacart says that 20% of its overall revenue will come from ads. So those are two things that I think were a little bit of a surprise to me.
Those numbers are way bigger than I thought they were going to be.
Yeah.
When you and I were talking in the pre-show, I think we both have two slightly different opinions that don't have to be mutually exclusive.
Right.
I won't steal your thunder, but I'll just say on my end, I think that, even though those numbers are bigger than I expected, I can't say that I'm surprised. When pay-per-click got hammered a couple of years ago with iOS 14, that budget had to be spent somewhere. I mean, it's not like CMOs and VPs of marketing were going to give up their paid ad budget. They had to put it somewhere. So naturally, for better or for worse, it went to display ads, and that's what you're kind of seeing here. I mean, at least from what they're saying in that article, it's like they're not really saying that it's affiliate or not. So let's just make the assumption broadly that it's display ads.
It seems like from the tenor of the article where it talks about serving up ads, sort of like after people have scheduled a ride or after people placed a food order, I would guess that these are more display ad based, just because I would think after those actions you're not typically going to be clicking to buy at that moment because you're either waiting for dinner or you're waiting for your ride.
Right.
So that's my 2 cents.
Coming from just a budgetary standpoint, that money had to be spent somewhere else. And if you can't spend it on PPC, and you're not investing, or, your business can't support like a direct relationship with the customer, then ads is kind of going to be where it's at. So I think until we see some other ad platform begin to demonstrate real yield on ad spend, I think you're going to see display dollars continue to go. But I think, and again, I'm trying not to steal your thunder here, but the other side of this is like, I would bet that people have been knocking on Uber and Airbnb's door or Instacart's door for a very long time in terms of ads. And I just can't imagine that number was large enough for it to matter until recently-ish.
Two things for perspective for folks. I did look up while you were talking. $3 billion in Instacart revenue in 2023. So if they're saying that 20% of their revenue is coming from ads, that's $600 million in ad revenue. And then Uber had just shy of $10 billion. You're looking at 10% of their revenue. So I have to go back and read the Uber numbers a little bit more, just to understand what's gross versus net on that, to understand what portion of it would be net income. Because, I mean, Uber is profitable, but not by a large chunk. So, I mean, it could be that the ad revenue is a significant portion of their net income, if not a majority of it. Probably not a majority, but could be significant, 20, 30, 40%, something like that. And I think, what I said to you in pre-show, I just think is just interesting is that, we've talked about how private companies have really had to push towards this, model of avoiding the capital markets if you can, and just finding a way to be profitable before you make that next raise, just because the markets are so unpredictable. And it feels like their publicly held contemporaries like Uber are also taking that same dose of medicine to say, look, we've got to find revenue where maybe we couldn't find it before, and it's more shifting from growth to profitability. Sort of like I remember when Apple declared that they were going to have their first stock buyback, or when they had declare their first dividend. That you're just part of like the growth of a company. And it does feel like Uber is pivoting more towards profitability, especially because I've heard from a number of folks on the travel side. You know that I've got a travel podcast and blog, and hear from so many people about how much the prices for Uber and Lyft have gone up over the past handful of years. And so that seems to be this push for these companies to hit some level of profitability so that they can move to whatever the next phase is for them. So here I don't disagree with your assertion for sure, and I think this is one of those cases where both of us could be right. I do think there's some urgency for these companies to find their way to profitability.
Just to summarize, though, you're saying that they had to accept the money, or they had to start moving into ads, not necessarily because the numbers got big enough, but because they needed that high margin revenue stream to yeah, okay, got it.
I think as a publicly held company, I think I hate to say it, but you're driven by quarterly numbers. And so how do you beat last quarter's numbers? I mean, it's sometimes the converse is true. There was an interesting tidbit back in the pandemic. So I know you remember this from all your days of flying United. Remember when you used to have to pay a change fee every time you booked a cash ticket?
Yeah.
And so change fee revenue was a massive bucket of revenue for the airlines. And as you well know, the change fees went away in the pandemic, right?
Yeah, but I assume that was, well, you're going to surprise me now. Go ahead. Why did that happen?
It didn't happen right at the beginning of the pandemic. And the first one to do it was United Airlines. And their CEO, if you take him at face value, which sometimes I do, sometimes I don't, the CEO, Scott Kirby, came out and said, I've wanted to get rid of change fees for a long time because I think it's a good business model for us as compared to, say, Southwest, which doesn't have change fees. He said the reason why we couldn't do it before was because it was such a big number and we're so driven by quarter over quarter and year over year returns. It was just such a big part of our business. Because there was no travel revenue in 2020 during the pandemic, there was no change fee revenue. So they didn't have quarter over quarter and year over year comps anymore on change fee revenue. So it was just, well, we're going to get rid of change fees and we're going to build some other revenue stream. And he said it was the first chance he had to cut those and change the business model in a significant way. Now, you would argue that if you felt strongly about that as a CEO, you would say, damn, the stock price this quarter. If this is the right financial decision for the business, you make the decision no matter what. But I do think there are plenty of decisions that are made where companies make choices based on the way they think the market wants them to go. And not that I think ad revenue is a bad thing per se, because we even asked your wife Dana before we were recording about whether she's seen ads in Instacart, because you guys are Instacart shoppers, and she didn't recall seeing any. And I don't recall seeing any in Uber in the app, nor do I recall seeing any ads on tablets and Lyft rides or something else that they said that they're doing. But these things exist. I just haven't seen them to be a big part of my life just yet. And so it does make me wonder, if this is, if this is a test in a brief moment in time where they're trying to find other avenues of growth, or if they really believe that this is going to be a big part of their ongoing strategy, that they're more content platforms and that the people in their vehicles or ordering groceries are actually the product and they're selling that product to advertisers.
Let's just say one of your portfolio companies came to you now and said, hey, Ed, should we accept ad dollars or start chasing ad dollars? And I know that's like kind of a broad hand-wavy question, but is there like a lower limit on how big a company needs to be or how successful it needs to be? Like, because I'm sorry for not articulating this well, but to your point, if these publicly traded companies need to raise revenues or increase revenues or whatever, I get your point that this is, they got to do this. I guess my poorly articulated question is if that's the case, should startups or privately held companies start to think about accepting ad dollars too, or chasing ad dollars?
Boy, two very different questions. So accepting ad dollars, 100%. Chasing ad dollars is a tougher one because, as I've learned just on the fringes with my travel blog, chasing ad dollars and having ad networks and fill rates and all that stuff, I mean, that's a complicated business and you need somebody that knows that stuff to manage it. So chasing ad dollars, that's a little bit of a tougher question to answer. I would never say a company should turn down ad dollars. I think the question I'd ask them is, do you have the resources internally to effectively chase ad dollars? Or do you need to hire another six-figure salary to make that go? We saw Reddit sort of float what numbers they thought they were going to have out there for their IPO. The ARPU numbers on Reddit are disgustingly low. And a big part of that is that Reddit just doesn't do a lot with ads on the site. I mean, that's just part of their user experience. So I think it would be detrimental to Reddit's established business to start throwing a bunch of ads on the page, because it's not necessarily something that their users are used to from an experiential standpoint. But for a lot of these other products, I could definitely see there being a path to ad revenue. I think it comes down to those two words you use. Would they accept ad revenue, or would they chase ad revenue? And I think that's the critical decision, whether you would accept or chase. What's your answer on that one?
For a lot of companies that you and I deal with, I think I would say broadly that if you're under $1 million a year in annual revenue, the answer is automatically no. You should not chase it or accept it, probably. And maybe that number goes all the way up to 10 mil in annual revenue. I would just say the answer is no. And I know that's a broad statement, but the reason behind that is that at the earliest stages, a lot of the funding that you're going to get is based on not only what you promised, but also on the sort of the expectation of like, hey, we're investing in this business that is probably like SaaS subscription based, or like, what you're trying to de-risk at the earlier stages of a company, somewhere under 10 million annual revenue or whatever per year. You're really just trying to de-risk the core revenue model of
Sure.
some sort of recurring revenue or whatever it might be.
That's fair.
And so like, you don't really get extra credit for unlocking a new revenue stream unless that thing is huge, right? Like it'd have to massively eclipse it. And then you'd have to be able to come back to the venture table and say, hey, listen, I know we were going to raise money on this other, business model, but man, we 10x revenue on this other thing. And
Yeah.
again, I'm just really early stage, so I think my answer would be don't even bother chasing it unless whatever falls in your lap is so massive that you can't say no. And even then you should probably say no because it's going to cause some trouble. On the venture funding side, it's going to cause some trouble because you might, presumably you've raised money from people that understand SaaS or whatever it is your business model was. And if you come back to the table with some entirely different business model, it's not it's not like magically SaaS investors are going to be like, oh yeah, I'll just fund your ad revenue business now. Right? I mean, it's just a different type of investor.
It is a different type of investor. This is probably one of those unconventional times in venture funding that you might have an easier time of getting a yes if there was that level of hockey stick growth, because there's just so much money on the sidelines. But I it's hard to disagree with your overall sentiment. In terms of whatever that core business is that you raised on.
It's a wild time out there right now. I don't want to. Again, maybe I'm just in like weird tax time, thinking about stuff, right? So it's hard to be optimistic when you're, writing a check to the man or whatever. But the fact is that, the bar is just 10x higher for everybody now.
Yeah. No, I agree.
We'll see how it goes.
Let's close with our checklist. So,
yeah, you're not going to miss any opportunity to give me a checklist.
Why would I do that? That just doesn't sound like any fun. So 3 things on your checklist.
My birthday was recently. You could throw me a little bone every once in a while.
Did you want me to sing?
No.
Nobody wants me to sing. All right. So the third thing that we're adding to the checklist: will you have purchased a ticket for Lubbock by the time that we record again?
Oh yeah, yes, absolutely. I got to do that. Tasha is probably waiting for me to do that, so I will do that.
All right. And you've said that you've actually followed up with Alex, so I'll have to go back to Alex and just verify that his questions have been answered there. And then what do we think that Matt Paulson will have this time next week? Do we think he'll have beacons, or do I need to send him like a fruit basket or something to kill some time?
No. You guys will have it. It actually works. It actually works. You can search, you can do all sorts of stuff. There's a little morning email that I wanted, primarily for some stuff that I want to track personally, and so I'm just trying to get that working. But yeah, no, it's ugly, but it's working. So
What they say, if you don't hate the first version of your product, I remember somebody saying
yeah,
something
yeah,
like
yeah. No,
that.
somebody said that seems to be really smart. Just
Yeah,
not taking his own advice, I suppose.
that's never happened before.
Nope, never happened before.
All right, well, I'm gonna let you go so you can get that extra time back to get cranking on beacons.
I love it, man. I love it. You're home right now. I can see.
I
Any
am.
any upcoming travel for you?
Well, there will be upcoming travel, but not this week. I've got a Reno and a Vegas and potentially a Lubbock. So
Ooh,
I have not booked my ticket yet either, but I didn't make any promises to book one. So
I love it. I love it, man. Yeah, I love it. Well, we've got a quick trip to St. John, another quick trip to Disney, and
very
then
nice.
another trip to Lubbock. So
I like it.
next 3 or 4 weeks are going to be kind of fun.
All right. Well, I will talk to you soon, and in theory, should see you in Lubbock in a few weeks.
I'm going to keep my fingers crossed, man.
All right, man.
All right, buddy. We'll see you soon.